Welcome to Founders Unplugged, hosted by Greg McCallum. Long-form, honest conversations with founders and entrepreneurs from around the world. This is part 2 of this episode. Be sure to check out part 1 if you haven't already. Link in the description.
This episode is brought to you by Founder Catalyst. If you're raising funds and you need to get yourself SCIS and EIS advanced assurance and you need some help with that, then stick around to find out how you can get 5% off of Founder Catalyst's services. Okay, and we're back for part 2. I'm here with Jed. If you haven't checked out part 1, please do so. It gives a lot of context as to what we're talking about. We're just going to be picking up the conversation where we left off, so you might want to do that if you haven't already. Thanks again for joining me, Jed. Let's pick up what we were just talking about. So I really wanted to ask about current portfolio. So, as you were saying, you've had so far, was it, if I remember correctly from your introduction, 1 exit, 2 currently looking like they might IPO. Is that right?
Yes, that's right.
So, but also more broadly about, are there any deals that really stand out to you? A lot of people always remember like their first, for example, or are there any of those that you're really excited about? You just thought really cool. Like, let's put the spotlight on some of these awesome startups.
Yeah. So the deals that I like to talk about arise because there was a bit of an unconventional thesis where we just looked at the deal in a slightly different way than other people did. I'll give an example. There's this, since you're in Europe, we'll talk about a European company. So this company is called Gladia, Gladia. And what they do is they have an API platform for real-time speech-to-text transcription. Okay, so it's like what you would expect from like Google Transcribe, like speech-to-text. You have captions on YouTube. We could caption this webinar, for example, but their focus is on real-time capability. I think that's really the crux of it, right? Because if you can solve speech-to-text in real time, super low latency, without throwing a slack of GPUs and compute at this to do this cheaply, now you've got a bit of an advantage because now you can start layering other services, right? So you can go speech to text, put that into, an LLM and to be able to provide responses, not just in text, but also go the other way and go text to speech, for example. So it's a real platform play.
Translation, presumably.
Correct. Exactly.
Yeah.
Exactly. The team was really interesting, very technically sound. And they were showing, kind of something like sub 100 millisecond latency using these H800 GPUs from NVIDIA. And for context, if people are not aware, this is the older generation of GPUs, right? We're talking 8-year-old technology, and they're still able to do this, which was very interesting. Wow. There are other players in the US that do this, right? And so intuitively, it looks like, okay, there's competitors in the market. Why would these guys win? And it's too early to say if it's going to bear out. But part of my thesis was that them operating in Europe specifically gives them an advantage to win in this market because they're forced to confront different problems. Take the very simple one of languages and translation. Right in the US, everybody speaks English, or maybe it's English to Spanish, and that's all you ever need to build for. But if you want to operate in Europe, now you've got to deal with French and German and Italian and Portuguese and whatnot. Right? And so it forces them to develop product in a way that is different from other speech-to-text players while still keeping this, real-time capability at its core. So that's a company I'm particularly interested in how they're going to progress in this market, right? I think that in a space like this, there's going to be 1 or 2 top players that dominate in any particular market and will win it. There's going to be 1 or 2 in the US, and I think the playing field is set, and I think in Europe, the field is open, and these guys could be one of those 1 or 2. So we'll see. This was like my thinking around this particular company.
But I like the way you've thought about that as well, because it feels counterintuitive to say, because they're going to be coming across these challenges. I think a lot of sort of playing it safe investors might have seen that as a negative, but you're looking at it from what's the word? Sort of almost a character building type perspective. It's like if you're going to be forced to have to go through these challenges, that's going to force you to innovate.
Exactly. The market context forces you to do certain things, right? And that could be your product or technology advantage.
Yeah. But that's the thing. I think there would have been plenty of other investors that would look at that and go, well, that means going to market is going to be slower. That means, we're going to start seeing a return on our investment slower. There's more risk. Whereas it's more of, well, actually, if you're competent enough to face those challenges head on and overcome them, the end result means you're going to be that much stronger, that much more resilient. So I like that way of thinking. It's broadly in line with the way I tend to sort of address problems. So that's an interesting one. That is an interesting one. Any others that have stood out to you? And by the way, is that one that has been syndicated, or is this one that just sort of one of your own personal investment?
No, this one I wrote a personal check for, right? We did plan to syndicate it for the Series A, but the deal was moving too fast. I couldn't pull it together in time. Right? This is one of the challenges of the syndicate model. But irregardless, the whole play is find the best possible companies, right? And back the right deals.
Yeah. So yeah, any others that have stood out to you?
Yeah, I mean, I can talk about my thesis for Turing. That one's obviously like a big shiny winner. And I think this particular thesis is interesting because it was a bet on remote and distributed work prior to the pandemic, okay? So let's talk about what they do. Turing.com, the company was effectively providing pre-vetted, highly skilled software engineering tech talent to tech companies on demand in Silicon Valley or these tech hubs. The problem you're solving is that in these tech hubs, everybody's trying to hire from within 20 miles of the office. By the way, this was 2016, 2017 or something of that nature. Right. And that's as a result, starting engineers' base salary is $250,000. Then you got to pay for their lunches, their massages, the foosball table, and all of that nonsense. And so Turing's idea was, hey, you know what? We can get you an equivalently skilled engineer. They could be sitting in China, in India, in Vietnam. You are not taking a full-time OpEx. Right? We're not placing, it's not an agency, we're not placing talent for you to hire. You're almost going to rent them by the month to scale up and down your engineering workforce. And if you look at the value creation, we're talking about base salary in Silicon Valley starting at, I don't know, $250,000, $350,000 versus paying a fully loaded remote engineer $70K a year. And you can go month to month, by the way. And even on that level, Turing could make 40% or 50% take rate on that wage while still paying the engineer the equivalent market wage. So they're not compromising on that. So everybody wins. The other part of the thesis, Greg, was I believe in that the future of work, right? Everybody says future of work, but what does it actually mean? For me, I believe that remote and distributed work was going to be a thing and is going to be a thing. Right now, the pendulum shifted the other way after the pandemic. There's a bit more remote work, but I think this is macro driven, right? Eventually, it's going to come back. Think about digital nomadism, right? This trend. People are effectively giving up a certain career path, traditional career path, in lieu of being in the office, right? They're making a trade-off and saying, hey, you know what? Being in the office, being tied down to one place and in a place where the cost of living is really high, it's just that trade-off is not worth it for me. And then I'm going to take a decision and say, I'm willing to have a little bit more career risk in lieu of like lifestyle. I want to control that, right? So that exists. We were also seeing around 2016, 2017, at the time that I made the investment, tech companies being built from the ground up fully remote. Okay, so we saw the first companies. A couple of examples were Zapier and GitHub. These are pure tech companies with an engineering backbone. To solve the shortage of engineering talent in their local offices, they went to a remote work model, and engineering was the first function in the organization to adopt it, which makes a lot of sense, right? Because it's just engineering and code. Engineers don't really want to be in meetings and talk to other people. They just want to code away and submit it. And then part 3 of it was a persistent shortage, a persistent skills gap between the demand for tech talent and the supply, at least if we look at it on a local lens. So if you look at the US Bureau of Labor Statistics, they were forecasting something like, I think it was like an 80,000 job shortfall between job openings in, in STEM fields and undergrads coming out of college. So it says like, okay, this market is going to exist and it's going to continue to grow over time. Those were like, the parts of our thesis. Of course, I'm not saying that we predicted the pandemic, but when the pandemic came and it forced all of these companies to go remote, it was just this massive rocket ship, right? And this company did something like, 3 to 5x year over year growth as a result of this, which, in a way like proves the thesis, right? When companies are forced to go remote work, Turing is going to be a beneficiary. We just had this acceleration event through a black swan pandemic.
Yeah. I'm really glad to hear you bring this topic up, actually, because this is something that I've been quite bullish on for some time. I remember literally the year before the pandemic, I was out with an old colleague of mine. We used to work together, and we were talking about remote work. And I was telling him, like, I'm convinced that this is the trend that we're seeing. Similar to you, I'd seen startups being built in that way at that point. But also just from my perspective as someone that was in sales for as long as I was, as an individual contributor and then sales leadership, what we would see quite often in sales leadership is that this would actually occur. You'd see it in tech already. So we'd see, offshore, etc. But then actually what we would see is within sales leadership, you would be responsible for running in-house teams. So inside sales, SDRs, BDMs, and so on, but then also a field sales team, depending on what it is you're selling. And that was a fully distributed, fully remote work from home, sort of quote unquote work from home thing. And it presented a number of challenges that you would have to use existing solutions for, and some solutions didn't exist for. And so that really got my head spinning, because as someone probably on the hunt for something to innovate around, that's what I was looking at. And that's been on my mind ever since. Funnily enough, the current startup is somewhat tangentially related to all of this, but and we were sort of sat talking about it for some time. And I was saying, look, that's a model that will. Why do our SDRs need to be in the office? Why did the BDMs need to be office? We're in an area, we're very restricted on talent because we're based on the South Coast. So it's like, we're constantly struggling, you and I, to find talented people. We're having to train from scratch, etc. So why aren't we hiring people who live in London? Why aren't we hiring people that live in Manchester? There's no reason they need to come into the office. And this was like, thought I was crazy at the time saying this. It's like, no, culture, and we need to, all this sort of stuff. I was like, no, dude, you can do that. We've got the tools, we've got the technology, we've got the solutions, But it sort of blew his mind. Now, obviously, it's all been accelerated that much. And I think that's only a good thing. And I agree with you. I believe that we're starting to see it sort of shift a little, but it's like an elastic band. I think it will come back again, and come back in a very big way.
Exactly. And the pullback right now, post-pandemic, has got to do more with like macro tailwinds than anything. Everybody's worried about a recession and that sort of thing, right? But when we shift the other way back to growth, and there's a competition for talent, companies are going to be forced to be more attractive employers. Part of that is, hey, you can work from home in your jammies 2 days a week, right? And like generally, like people love that. I don't have to take the commute. I'm just going to do my thing, and it's great.
I have a lot of strong feelings about this, and one of them, which I'll share, I won't share all of them because I don't want to bore you, is the fact that the bigger issue from my perspective with why it hasn't worked or isn't working with a lot of organizations is because they don't have the skill set, essentially, from the top level on how to run effectively remote organizations. It is a skill set.
Hi, a friendly reminder to share this episode with your network, like, and subscribe. And if you are feeling really supportive, please consider reviewing the show on the podcast platform of your choice. It all really helps support what we do. Thank you. Now back to the show.
It's not something that you can just do. You can't just get an organization, make everyone work from home and be distributed and expect it to work. Even building a company that's fully remote from the ground up, so not even having that shift, you still need to set a certain amount of infrastructure that's very unique to that setup in order for it to work efficiently. And the main driver, I personally believe, is ensuring that there is the the motivation in place. There are sort of infrastructures in place that continue the motivation to remain, and that's not just sort of to earn money or whatever, but the actual ultimate to keep people on their eye on the mission and the vision of that organization, and that's very, very hard to do in an environment where people are distributed, because you haven't got that in-person shortcut of being able to, kind of to your point earlier about the psychological effects of having groups of people spending time together, and how ideas can sort of be viral and people can kind of conform with one another. You haven't got that psychological effect that occurs there. Everyone feels far more independent with their own set of independent thoughts, which is obviously a good thing. You don't want people to be robots, but that is a bit of a hack that companies, I think, have taken advantage of for many, many years, in putting a bunch of people in the same room, getting them to sing off the same hymn sheet, and generally they sort of fall in line and just do as they're told. So because of that, that's a strength, because it means people are more likely, like you were saying earlier on in part one, to be more innovative, to challenge, to disrupt, and to be more creative. But on the flip side, it does mean that if that isn't curtailed, it can actually be destructive, and it can be non-productive. And so it's about creating processes. And I think ultimately what that comes down to is doubling down on what you're doing to work with people's career progression and career development, being hyper-focused on coaching, feedback, and actually showing that you as a company are invested in them as individuals and their overall growth. Because if you're showing them that you're investing in them, they are far more likely to reciprocate in kind. That's my thesis. For what it's worth.
Yeah, there was just to tack on to this, right? There was a very interesting data point that I used to build my thesis for Turing.com. This whole like remote work thing. Somebody had made this chart, right? They scanned Hacker News, which is like Y Combinator startup job board, and they tracked every single company, the number of job openings that were remote versus in the office. And what you saw was that prior to the pandemic, over, let's say, a 5-year period, right, the amount of jobs that were remote had actually kind of ticked up slowly between 20 to 30%, which, if you think about it on a 5-year timescale, it's not insignificant. But when the pandemic hit, the amount of remote jobs like basically skyrocketed to like 80%, and kind of my thesis there was like, look, this is structural, right? This isn't a blip that comes back all the way around. Yes, it can come back, but we're not going to course correct all the way, right? And it's also this idea of structural shifts, I think, that unlock how work is done in this particular case.
Yeah, absolutely. Yeah, I think it was always a trend that was going to occur. It just may have taken a little longer without the little push from the pandemic, but it was always on its way, for sure.
For sure.
Yeah, but like I said, I think the one downside is that people weren't able to organically find the means and the structure to do it effectively. That's the only downside to the push that the pandemic caused, unfortunately, which is why we're seeing it kind of revert back for some of those companies that have struggled with that. But again, they now, I think a lot of tools are being created, a lot of innovative startups and innovation, and I think just general competency around it is evolving back again. And so then I think it makes the ability to run organizations effectively in that way a little bit more tenable moving forward.
Yeah, it's an interesting way to look at this space, right? Because the solutions that have emerged tended to be around, the administration, the HR, right, and the payroll and hiring and all of that sort of thing, right? But yeah, maybe there is a play around like how do you kind of build and maintain remote work culture? Nobody's actually kind of like solved that in a meaningful way, I don't think.
Yeah, well, that's what I'm banking on to some extent with my thesis for my own startup. But no, I think that's largely spot on, because I think one of the things that people latched onto was this. It is kind of a bit of a what's the term? A bit of a armchair psychology concept of communication being a very fundamental thing to running an effective company. Which, of course, communication to an extent is true, but it has to be curtailed communication. It has to be compartmentalized communication. And the problem that really exacerbated things was exacerbated hugely when it came to the shift to remote was actually overabundance of communication, actually, when it came to communication in that environment. So whereas before, in person, you're restricted to communication with just the people that you're speaking to, that there was an easy way of segmenting the things that you would communicate with online, whether that's email, Slack, whatever. When you're remote, suddenly everyone is communicating with each other constantly all the time. And then so that then shifts a real big issue with prioritization. Because you don't know what to prioritize, and that, being self-sufficient and knowing what to prioritize is a very unique skill set to have. Like, I know founders that still struggle with it, and executives that are meant to be highly competent in that way of being able to know what to prioritize. So to suddenly expect everyone at all levels to suddenly be able to do that with this overwhelm of communication, it was the wrong move. It like you said, everyone was focusing on the admin side of things essentially, and they forgot that the side effect of that is not everyone is an administrator. Not everyone needs to have that amount of information or can handle that amount of information. So I think it was focusing on the wrong thing, but very well intentioned. It needs to be taken back to segmenting, compartmentalizing, and understanding that people work better in a smaller sort of environment. But anyway, I digress. I'm kind of going off on the rails there. But that's I think where it kind of went wrong. So we saw a lot of innovation and tools around there, but then I think that had a negative effect. So we'll see. We'll see where it goes. As you can see, I've got a lot of thoughts on it. Yeah, hugely interesting. So that was obviously a pretty good bet for you and for this and for the group. So that's a great example. So then, any others stand out to you? Any other companies?
I'll talk about one more. This company I really like. They're in a dead boring space. It's tied to.
I love these ones though.
Yeah, I know exactly. Intuitive, right? It's a dead boring space, but it's also tied to this kind of like remote distributed work angle, right? So we talked about these HR and administration like platforms for remote teams, like if you got a workforce around the world. Another company that I've backed is growwork.com, GROWRK. They do the IT asset management side of the house, right? You've got employees around the world, an office, I don't know, in Bangalore with like 10 employees. How do you get people laptops, making sure they have the right software on them? What happens if somebody quits? Do they just hand it to somebody else and then they stick it in a desk drawer? It gets lost, there's no visibility, all of this. So what GrowWork does is they have global scale procurement and a management service that takes care of the logistics, the delivery, the storage, the wiping and resetting of devices and the life cycle part of it. Big market, obviously. I think there's a business like this, we like the revenue mechanics in that companies pay every single month for the subscription fee to manage every workstation. But GrowWork as a company only incurs the cost when something happens, right? A employee leaves, the laptop gets dropped in the toilet or something. This is when the cost incurs. So the revenue looks a lot more like insurance float than anything. And I think a business like this, if properly managed, can be just a cash generating machine. For reference, today this company has generated, I think, $3 million of pure annual recurring revenue, having burned only $1.7 million in cash.
Yeah, that's not surprising though, for all the reasons you just laid out. There's another part of this that I've been thinking about for a long time, and I'm so surprised that I've not seen a play. Maybe you have, that I've not seen a play on this, which is the cybersecurity side of this issue too. Like, it still boggles my mind that there are incredibly large organizations that have remote teams working from home Wi-Fi, no cybersecurity precautions in place, and I don't yet entirely understand why we haven't seen a strong offering in that space that has really caught everyone's attention and that is just spreading like wildfire. I suspect it's because a lot of these existing cybersecurity companies aren't particularly good at branding themselves and coming across with the right messaging to maybe tap into this. They come across as quite all-encompassing, maybe a little bit bloated. I don't know, but I suspect it's something wrong in the way that they're positioning themselves to appeal to these kinds of solutions. Maybe it's pricing as well. I'm not sure, because
What
companies are quite
is
overwhelmed in tech stack too.
Yeah, just want to make sure I understand like what you're saying. Is it that for remote workforces, people working from home, like home Wi-Fi, it's just like kind of unsecure? This is the
Incredibly
cyber
insecure, yeah.
risk. Yeah. No, I don't disagree with that. I guess it's like don't like kind of VPNs kind of solve that problem. You could like require. I mean, it's super clunky, by the way. I mean, I agree with
Yeah,
that.
well, and this is it. So there's an organization that I helped start up shortly after the pandemic, and that's exactly what we did. And it was a horrible user experience for that reason. It was incredibly clunky. It wasn't purpose built for that kind of way of doing it. So we're very much retrofitting it. And even recently, I looked at it for another company I'm helping out with some of their operational side of things. And this is my point. There's no one that's sort of come out of the gate saying we're the VPN company for distributed workforces. Like, where maybe there is, I'm just not seeing it. But I'm surprised that I haven't, given that I'm the target market. I'm in that space, so that's kind of my point. I've not seen anyone really push that out the gate. So if anyone's listening and they're looking for a business idea, there's one right there. Because I think that's a huge missed opportunity.
Yeah, it's a little bit conflicting, right? Because a company is going to be, if they're paying for a corporate VPN for employees to use while at home, they're going to be paying for the bandwidth and all of that stuff, right? And this
Right.
weird thing of, okay, VPN's got to be on when you're using the company laptop, but if it's for something else, you got to turn it off, right? And there's that user experience that's super annoying.
Yeah, exactly. So there's got to be a solution there, though, because why wouldn't companies want that to protect their data? I mean, we're also talking from a legal perspective. In most jurisdictions, you can't operate an organization where you handle people's personal information, especially under EU GDPR regulations, without having safeguards in place to ensure that there's a protection of that data. So we've got all of these points on cloud storage, and things like that. All of this regulation, like, that's quite heavy, that prevents
Yeah.
companies from being able to do certain things and be. But then you've got Jimmy, who works in customer success. He works in his mum's basement, and he's using home Wi-Fi, access to the full CRM, support tickets, all customer information, and he's on Wi-Fi that the password's still password. Do you know what I mean? And it's like it kind of undermines the security of the entire company, but it happens all the time.
Sure.
And that's just crazy to me. So there's got to be something there. There's got to be.
Yeah.
I don't know what it is, though. Maybe that's the next business. But no, some great examples. So then, look, let's talk. We've done past, we've done present. So let's talk future. What are your ambitions and plans? Well, no, actually, before we do, let's talk a bit more about the education side of things. I said I wanted to delve in on that. So how did that come together? Was this something that you were tangentially building always kind of alongside the syndicate, or did this come a bit later?
Yeah, I think, when I started the syndicate, it all came together quite quickly and a little bit too well, right? Too well in the sense that how does somebody who effectively has no idea what he's doing and is figuring out this process on the fly pull this together? I was like literally writing $250,000 checks on the weekends doing deals while I had a corporate job. Right? It shouldn't be possible, and I think it just meant to me that, look, something here is working. The question is like, what is it, right? And I basically started distilling that.
Raising investment is painful enough without getting bogged down in the legal costs. That's why I'm using Founder Catalyst, today's sponsor for Peer, my startup's pre-seed raise. We've been lucky enough to have Sam, the CEO of Founder Catalyst, on the show before. Go and check out that episode. Their funding round service offers the most cost-effective way to produce funding round legals in the UK. It's just £1,495 excluding VAT, with no monthly fees or hidden extras, no matter how much you're raising. One Founder Catalyst customer recently raised 2.7 million and saved around £10,000 compared to the next option. If you're looking for SEIS, EIS Advanced Assurance, they've got a 100% success rate over the last 3 years. Founder Catalyst is built by founders for founders, and from my own experience, I can't recommend them enough. You can scan the QR code on the screen around here somewhere or around there somewhere, I don't know, or use the link in the description for 5% off. Thank you to Founder Catalyst for sponsoring this episode. Now back to it.
Then I latched onto this idea that, hey, I've had to figure this out on my own because nobody is doing this. And then if that is the case, is there a market? Then it becomes, is it worth building for? And, let's go figure that out. And that was kind of like the genesis for Angel School. I think what we've done now is we've evolved a little bit. It still has a lot of the education flavor. I kind of describe what we do as an accelerator for angels. We want to be with them from the 0 to 10 of their journey, right? 0 to 1 means just learn how to be the bread and butter venture investing skills as an individual, not the VC perspective, because that difference really, really matters. The 1 to 10 is if you're an experienced investor and you want to build your own angel syndicate, we've got a program for that. So there is a mission underlying all of this, Greg. And one is that I think venture as an industry is guilty more than most other industries of having a lot of gatekeeping. And it kind of irks me, right? It's a very exclusionary industry. And I find the behavior honestly quite ugly. People who are in it, just by virtue of having a VC job, I'm not saying that they're smart, they're not talented, they don't deserve where they are, but they just kind of get into this private club and everybody else is just not a VC. Somebody's got to bring the capital that gets these startups to VCs in the first place. So I think it's a symbiotic relationship. Now, the other part of what I find intuitive about venture ecosystems is that the balance is wrong in terms of resourcing. By that, I mean, intuitively, most governments, regulators, any of these forces that's trying to grow an ecosystem, we always go, let's go help the founders and startups, which is fine, of course. I have no issue with that. I'm not saying that they don't need it. My issue is that we treat the investor side of the equation as an afterthought, or it's a little bit of a zero-sum game, or not a zero-sum, a fixed-sum game. We say, hey, if you're looking for funding, go find angels, an angel network, or a VC fund, full stop. Right? If you've done this, you and I will know that learning venture to be an investor, it's a really hard skill. It takes a lot of reps and it takes a long time to learn. And so the mission is, how do we grow that side of the equation? How do we grow that pie? Because the way we're going to bring balance into this equation where everybody is focused on, okay, let's go help the founders and all of this, is you need to bring the capital side up with it. And so the mission is, how do we bring more people into this, right? Help them invest in their own investment thesis. It doesn't have to be mine. I'm not looking to convince everybody that, hey, B2B and technology and software is the end all and be all, right? Everybody can go invest in what they want. What I want them is to have the skills to be able to evaluate deals and to do the deals that they want with eyes wide open. So that's kind of like the thrust to the education business.
Would you say that there are some that you've managed to distill this down now to some at least starting point fundamentals that you believe quite firmly in? So, that 0 to 1 part. Do you, because if we have quite a lot of, like I mentioned, the audience of this show is founders, but we also have quite a large portion of that group that are looking into becoming angels.
Yes.
Whether and I get asked this a lot. So what are the basics? Have you got any words of wisdom in that area?
Yeah. I'll start off by saying, right, I think that the true founder and the true angel persona are two sides of the same coin, right? These are different parts of the life cycle. We kind of go back and forth. At some point, I'm firmly convinced you'll find yourself on that side of the table. But general kind of like starting point is, or general guidance I give to investors who are starting out is that really take your time. Right? Do lots and lots of reps, see lots of pitch decks, lots of companies before you pull the trigger. If your selection rate is 100 to 1, you should be learning more from the 99 companies that you say no to than the one that you say yes to. I happen to disagree with the concept of power law a little bit, with a caveat. So if somebody's listening and they're not familiar with power law, right, this is something that you hear in venture capital all the time. It's an argument for diversification. Okay, power law effectively says that There are very few companies in a portfolio that will return outsized returns. The vast majority return very little or outright go to zero. So you need to place enough bets so that you have a meaningful chance of hitting that 100, 200x return, because frankly, the rest are going to zero. That makes sense as a law of statistics, right? As a law of math. I agree with that. My disagreement comes from the fact that I think it is a bit of a myth perpetuated by venture capital, because venture capital funds lever up on capital, right? Think about this. There's something in a VC fund called paid up capital. This is effectively how much the partners need to invest into the fund to show that they have skin in the game. And if anyone's not aware, that number is in the order of 1% to 2% of the total fund invested in by the general partners, and the rest of it is from investors, which means that a VC fund, the partners of a VC fund lever up on capital 50 to 99%. 50 to 99 times on investor capital. They get to amplify the upside because they take carried interest on all of the deals. So power law exists as a law of nature, true. However, the risk is different for investors individually versus VCs, because VCs get leverage. They amplify it by raising 50 to 99 times more money from investors, and they get the upside. But when an investor invests their own money and the bet doesn't turn out, you basically lose 100% of it, right? So this is why I agree, and why I say I disagree with power law. And all this to say, my takeaway here is that if you are an individual investor investing in venture as an angel, you have to weigh the risk of you have to weigh the cost of failure much more highly than a VC, because it's personal capital. Because you don't get amplification on that capital, you don't take better economics, right? So those would be my advice for investors, right? And I'm basically arguing for a bit more conservatism rather than just investing in as many companies as possible. I'm saying actually take your time. Yes, diversify, but take your time. Build your portfolio over 5, 6, 7 years. Take your time with it. Don't be in a rush to pull the trigger, right? Because once you do, that capital is out the door, and you shouldn't expect to get your capital back.
Yeah, I think I've been given that advice, the opposite advice before, of diversify, going quick, and all that. I think there's an element of FOMO as well, which is if it's something missing out potentially on deals, but also because of the timeline of potential returns can be that sort of 5 to 8 to 10 year timeline, that there's this idea of I'm running out of time. I need to get in now because then I might see those returns earlier too. But
right.
I think you've absolutely hit the nail on the head.
And I agree, right? Those timelines do exist, but I'm also kind of like arguing the perspective that when you're starting out, your lens is the most uncalibrated, your lens is the most rough.
Yeah.
Right? Just intuitively,
you're just shooting in the dark.
You're the least likely to be successful. And to build on this point, right, around venture, right? What do people say? It's an illiquid asset class. It's a super long holding period. It's risky. Now, those things will never change. People talk about it and it's a truism, but they will also never change. If you never have a solution to it, to me, it's effectively we're just whinging. So what is the solution to it, right? And we've taken that thinking into our education programs, right? One is like great education is we want to de-risk by giving everybody a good baseline to go into this with eyes wide open. Right. And if they look at all of this, they take my program and they say, like, this is bad shit and I should never do this. Well, you know what? That's fine. Take your money. All you spend is, you learn a few things, took a 1-month program, it costs you a few $100s, and walk away. And that's fine. You'd be better off. But if you want to play in this, we also give them a forum to be part of our investment committee, right? Where we meet, and all it is we're having a Zoom call once every 2 weeks. We're looking at a pipeline of vetted deals, and we're talking through the thesis. We're challenging each other's thinking, and we're saying no a whole bunch. This is what I'm known for, right? It's like, yeah, he's just the guy that says no to everything. And it takes a hell of a lot to convince me to say yes.
Yeah.
But when I do, it means that we've got conviction, right? And we take the investors along for the ride with us, and they say, now I get why this is a yes, why this deal makes sense, right? Why we're doing this deal. And by the way, we do this without treating the investment committee as a captive audience. I know some other programs that do this sort of format, education plus some sort of engagement, type of forum. But the end goal is to capitalize this audience, to get them engaged on the deals, to get them to invest. And by the way, I wouldn't, turn investors away in my investment committee if they decide that they want to invest. I'm saying I don't need your money because we've got a network of 1,400 investors that are backing our deals. We can solve that problem, right? And so there's never any pressure to invest. If it's not the right deal for any reason, I say, hey, just walk away. No worries.
What is it about angel investing that you enjoy?
I've got a few motivations, right? Or as a general rule, my goals in life boil down to two things, right? Number one is I never want to work for anyone, and that's kind of like box number one tick. It's also why I've never taken capital for Angel School. We're fully bootstrapped, right? I just didn't want investors and shareholders to report to. The other thing is I want to be in a position where I can own my time, and that requires financial wealth. I think that venture is the only asset class today where you could systematically play for life-changing money, right? So there's a potential path to that. Beyond those, let's call it self-interest goals, I think there's also a level of kind of like intellectual purity and intellectual challenge, right? And to look at every single deal as a problem in itself, right? And solving it. And it requires, different approaches, and it's really challenging. Due diligence is really hard work, honestly, and it takes a certain type to not see it as work and as part of this problem. In another life, I might be a golden retriever, trying to get a piece of kibble out from a ball or something. But I think fundamentally I'm motivated the same way.
Yeah, they're like it's like solving puzzles.
Yeah,
In
for sure.
a way, isn't it? Yeah, it's
Absolutely.
yeah. That sounds very similar to my motivation for still. I don't do it as much, but I still offer pro bono commercial advisory sessions to pretty much anyone who wants them. And part of what people are always ask me why do you do that? I will literally make the time to do it if I have to. It's because I just love the challenge of the puzzle. It's there. You can see it. You can see what the completed thing kind of looks like. But there's that challenge of trying to piece it all together, which is incredibly satisfying. So I get that. So what does the future hold? I'm assuming you've got plans, right? So are you able to spill the tea a little bit? Tell us kind of what some of those are?
Yeah. Right now, look, I see two paths to what we do, right? Number one is stay the course. We've got a 1,400 investor network. It's self-reinforcing that it grows on its own without us doing anything. It's a magical machine. We put ourselves in a position to be writing $1 million checks, and as we scale, that will grow. And I'm hyper efficient with it. So that will continue. We will continue with the programs and bring those investors into our investment committee, because that's going to be our engine for sourcing, for doing diligence, and making great decisions. So path number one is we almost franchise Angel School around the world, right? Because today I have 3 investment teams. There's a US one, a Europe team, and a Southeast Asia team. And so do we continue with this? Do we open up new markets and just enlarge the network? That's one. The other path, and I'm not foreshadowing this, right? It is something I have thought about, but I am not sure that it will come to reality, which is, should we have a fund?
If you are enjoying this episode and want to support the show, please like, subscribe with notifications turned on, and let us know your thoughts and opinions in the comments below. This lets YouTube know we are doing something right. Back to the show.
To be clear, I wouldn't start a fund for the sake of ticking a box, just to say I did it. I would be doing this to prove a very specific thesis. And firstly, it wouldn't be anything less than $100 million fund, right? Just because it would not be interesting for me. I'm in a position now where potentially I could be out of the game and retired in 3 to 5 years if things break my way, right? So I like that timeline. If I do a fund, it's a 10 or 12-year commitment. So the question is, okay, what would make the juice worth the squeeze, right? Why play this for another 10 to 12 years? And frankly, it's more than money. It's to prove out an intellectual innovation, which is that if I could operate a large-scale investor syndicate, which we've done, alongside a sizable fund, we can basically make 1+1 = 3. That is the innovation that would motivate me to do this.
So it sounds like you're not entirely decided there.
I'm not. I don't like going into things half-cocked or without full conviction, right? I'm kind of like an all-in kind of guy.
What would tip it for you either way, do you think? What would have to happen?
I think I'd want to kind of stabilize the infrastructure that we're building around Angel School as a syndicate more. Like, it's got to be a revenue and pipeline generating entity that's self-sustaining, right? Because I would need to free up my time. The other side is of the fund, do we have the right level of interest from investors to go pitch this, right? And I'll go in, I'll do the pitches and to see what signals the market give us. But if I were to do this, the fund would resemble more like an opportunity fund. I wouldn't do this like every other fund does, which is, here's my thesis, I invest in this stage, this sector, this year, right? Now, too many constraints. What I'm saying is, with Angel School, we have built this large-scale deal sourcing and due diligence infrastructure to operate at large scale. Like today, we can do due diligence on 5-10 deals in parallel at any one time, just because we have this mechanism. And this is a very hard challenge to solve. And we are basically going to invest in opportunistic deals in certain geos, yes, but we're going to widen out the stages, we're going to widen out the sectors. Because we've got this infrastructure in place. So all of these things need to line up, right? Otherwise, I probably wouldn't pull the trigger on it, and it just stays like a dusty idea, a dusty script in the closet.
Yeah. Well, that's I'll be excited to follow the journey and see which path you decide to go down. Before we wrap things up, I'm curious to know, sort of speaking directly to the founders out there, and also from me. As a founder, what are some sort of common mistakes that you're seeing founders, startups, maybe more broadly, making that you find either to be incredibly frustrating or just that are maybe easily solved? Yeah.
I'm going to put my investor hat on and talk about fundraising.
That's what I'm after.
So I'll caveat, or here's a preamble on this section.
Okay.
Right? I've realized what I do with Angel School, or the syndicate model of investing, is it gives us a very specific lens on fundraising. Just think about it. Only syndicates have to do deal-by-deal fundraising. Angels don't do it. They deploy their own capital. VC funds don't do it. They market the fund. I go out, I find companies, I do due diligence, and I say, is this a good company or not? If yes, now I've got to package this up and to sell the deal to my investors. So in a lot of ways, once we pass the diligence process, I'm maximally aligned with the startup founder in terms of wanting to get the deal done and moving as much capital as possible from my investors into the deal. We think of fundraising in stages. The number one advice that I have for founders is how you make your approach and your messaging to investors when you're fundraising. It is the number one thing that is overlooked. It is also the easiest thing for you to fix. Think about the business that you're building, the business model, the market. You can't change any of those things. They're fixed, or they're very, very difficult to change. But what you can do better at is how you position the company and to communicate it. From all the founders' pitches that I get, and also some investor pitches, it's a hot mess, Greg. I think the way you have to approach investors is the currency that you're dabbling in is mind share and attention. When you're approaching an investor, you have to reduce all of the friction. You've got to make your company understandable and compelling in 30 seconds. Right? It's literally like going into a job interview and somebody's doing that first scan of your CV. It is that brutal. So I encourage founders, sit down, strip out all the faff. I don't care about what you're revolutionizing, what all-in-one. All of that is just words and noise. Get down to the very essence of what your company does, number one. Second, why you're special. Number three, back it up with numbers. Okay, just lower that friction and get in front of investors. That's the number one piece of advice that that I can give founders. And in fact, when I market deals, I draft up an email and I send it to myself. I'm literally cutting down words. Like, how can I change verbs and nouns and literally cut down words to make it as frictionless as possible for my investors. So think about it the same way. It's not capital you're after, it's after somebody's attention.
That is something that I wholeheartedly agree with, especially from my sales background, right? Because of, I compare the raising process as I would do with any other sales process. It is
For sure.
sales, and
It is,
you
yes.
you can't convey. A pitch needs to be succinct. It needs to get to the point quickly. In any form of sales outreach, that's true. And however, there is really interestingly a dilemma that I've encountered, because we've just announced our pre-seed, and we've been spending a few months preparing for that. And I've encountered a dilemma that I didn't expect I would encounter, which is people hire me to help them with their messaging. And I'm really good at it, right? I'm very good at people telling me their concept, their product, their service, whatever it is. And once they've told me, I go, okay, then you need to say this, and this, and that'll do it. And then it goes and it works, right? I'm very, very good at that. I'm not so good at that with my own startup. It's really interesting. There's some psychological blocker
Yes.
that prevents you from being able to do that with your own business. And it's a really difficult thing because there are so many pieces of the puzzle of our startup. And plus, it's in AI data infrastructure, which in itself has some technical complexity. And there's some blocker which is like, oh, well, we can't not say this. We have to say this. Otherwise, they won't get it. And you end up with just too much information. And it's a constant struggle. We're still refining it now. I'm still refining it every day, working on the message, the pitch deck, everything to make it simpler and simpler and simpler. But it just still doesn't feel like it's there.
Correct. I think you hit on the right point. It's psychological, right? So I actually have that issue in that we get a company, we spend all of this time on diligence. And so your lens is, I don't want to say clouded in a bad way, but it is colored, right? In the same way as a founder, there's so much detail, everything seems important, you can't abstract to the right level, right? Which is why this exercise is actually unintuitively difficult. The other reason that it matters so much, Greg, is that I've seen this pattern play out on every single deal. So I know it to be effectively a universal truth. When I push out a deal to my investors, right, the magic number is 3. I want to tell them about the deal 3 times to maximize the interest. After that, the attention falls off a cliff. You just seem a little bit desperate and needy. The very first touch point where you tell somebody about that deal, right, I give myself 10 to 12 lines of text in an email. That's all I get to say. 70 to 80% of the deal interest comes from that single touch point. So it's absolutely crucial, because if you don't do that well, you pick up another 20 to 30% in the second and the third follow-up, but not that much, right? Which
First
is why,
impressions.
exactly, it's first impressions. Exactly.
Yeah.
Well, I'll say if you want a fresh lens on what you're doing, send it my way. I'll be happy to take it.
That. Probably need it. But it's a really interesting conundrum, and it's the one that keeps, I think, the whole ecosystem alive. But it's interesting too, because there's ego at play as well, which is a really problematic thing to deal with here, because there is also this sense of, if someone says to you like, oh, you should take this out, this out, and this out, then a part of your ego is sometimes hurt of that too. It's like, oh, but I thought that was really important.
Yeah.
Or like this person just doesn't get it, and so it's very difficult to separate yourself from that and go, well, no, wait a minute, if they're saying it with their experience, they must know what they're talking about, but the problem is, I think we just overthink it ultimately. We overthink it. It's difficult. It's very difficult. And I never thought I'd find myself difficult. Yeah, and I never thought I'd find myself in that position. I very arrogantly came into this thinking, well, this is what I do for a living. I'm going to be great at this. No, absolutely not. But there you go. Yeah, I mean, or maybe just the startup idea is crap. Maybe it's that simple. That's always a possibility, though, right? That I have to be honest about in my mind. It's like,
It's good to keep an open mind. It's better you find out early.
yeah, exactly. So if we can't pitch this and it's not pitchable, maybe there's something fundamentally wrong with with the concept, But I don't know. But no, I appreciate the offer. I may have to very well take you up on that, and I have taken other people up on that too. I think it's an incredibly important thing to do, to ask for as many opinions as possible. That is one potential solve. Here is just getting as many people who aren't invested sort of in any way emotionally or monetarily in your startup to get that extra pair of eyes.
Exactly. It's just enough data points, right? At some point, you got to listen to what the universe is telling you.
Yeah, absolutely. Yeah. It's an interesting one. Well, look, we're approaching the end. So typically what I'm trying to remember to do towards the end of these conversations is asking my guests to tell me if they're to bring up a topic or to address something that they think is important but isn't being talked about enough of. Do you have any of those things that kind of spring to mind?
Yeah, I'm going to bring up one, and I think that the world of venture romanticizes VCs a bit too much.
I had a feeling you might touch on this.
Yeah, I don't want to say this like I've got a chip on my shoulder, right? I really not. And I think all the pieces in the ecosystem need to exist. Angels need to exist. Syndicates need to exist. VCs need to exist, right? We all got to play in our lane. We all have a part to play. I think the over romanticizing problem, comes when founders, I guess, like covet one source of capital over the other, right? Or actually, sometimes it's also healthy when VC investors will go, oh, angels, they don't need to make the same returns as we do. It's like, well, hold on a second. I invest early in riskier stages. I mean, I understand you have a fund and LPs to report to, but why don't I deserve, as high returns, right? I think for all of us to survive and thrive in this ecosystem, everybody's needs a fair share of the pie.
Yeah, that's a fair point. I mean, what works in the upper echelons of Silicon Valley doesn't necessarily work everywhere else. And I think that's maybe where a lot of that that perception has been pushed across the world of, that ecosystem of venture capital, of people working at that sort of level, and that typical model of, concept, VC fund, VC backed, go to market, scale, all of that has trickled down to the rest of the ecosystem. But that's a very unique scenario, and it's changed. I am finding more and more now that the more founders I'm speaking to are talking about angels more as a first point of call for funding over VCs, which is great. I think that education is spreading out there, but more importantly, I'm also seeing more conversations. I'm very glad to hear of people just getting on and generating revenue. as the main focus, which is also nice.
Let's get on and build the business, right?
Because a few years ago it was like, I've got an idea, how do I get funding? So what are you talking about? Go and build a company, man. Like, most ideas, there are ways of generating revenue, even if it's a purely SaaS concept or something like that. There are ways of actually getting traction on that before you need to go and talk funding. If your whole entire concept hinges on you getting external funding in order to get off the ground, then it's fundamentally broken, I would argue.
That's right. I mean, I've one thing I've kind of like learned as an investor is that capital isn't always the answer. Like, it takes some problems can't be solved with capital, right? And in fact, you're not putting capital into the right things. You're scaling faster to zero. We've had portfolio companies raise money and then fail to meet expectations, right? They bootstrapped for a long time, did really well, and they raise funding and you think it's like pouring gas on the fire, and then the growth doesn't materialize. Why? I think it's part of this equation, right? It's also investing in the right things.
Yeah, absolutely. Yeah, well, I mean, I could easily take up another 2 hours of your time. I've got a million other things I would ask you about and we can talk about, but I'm going to let you go because I know you're incredibly busy. You've got a lot of people relying on you by the sounds of it, so I should free up your time. Got an interesting week ahead?
Yeah, I do actually. I'm starting a webinar series this week called Building Angel Syndicates.
Oh, okay.
We did a marketing thing that was like catching lightning in a bottle, Greg. We have 525 people signed up. I'm
Wow.
like pumped.
That's going to be awesome.
Yeah.
Amazing. So is that running throughout the whole week?
No, we're going to do a three-part series. So one this week and then another one the next 2 weeks. So
Right.
it's going to be 1 hour sessions. It'd be a good way to just share what we know with the community.
Yeah. Well, that's amazing. Well, unfortunately, by the time this comes out, that would have been and gone. But I'm sure you're going to be doing something like that again if it's a success. So for those listening and watching that are interested in that, I will obviously be putting your LinkedIn in the description and probably the website for the syndicate and everything like that in there. Is there anything else you want me to pop in there? Any people you want to shout out? Anything at all?
No, this has been a wonderful conversation, Greg. I appreciate the invitation. It's been a long time coming. I'm glad we're here now, and I really appreciate the opportunity.
Likewise, man. Thank you so much. You've been really generous with your time, and I can't thank you enough. So yeah, all that's left to say is thanks for joining me. And for anyone listening, watching, connect with Jed if you're interested in learning about how to be an angel or want to join the syndicate, all that sort of stuff. Just get in touch with Jed. I'm sure you won't mind a bombardment of messages, as if you haven't got enough to do already.
It's all right. It's a good problem to have.
Yeah, exactly. Well, thanks again so much, and yeah, hopefully we'll catch up again soon.
Sounds good. Thank you, Greg.
Take care.
Thank you for listening and/or watching. Please like and subscribe. Or if you are listening via podcasting service and want to show your support, consider rating or leaving a review. It really helps. See you next week.